The billion-dollar battle that almost killed India's oldest stock exchange. India's oldest stock exchange was almost brought to its knees by its own rival. You won't believe how close it came to vanishing. This is the story of the Bombay Stock Exchange, 150 years old, iconic, and nearly erased by a competitor in just 20. What happened? Let's unravel the billion-dollar blunder you've never heard of. Founded in 1875, the Bombay Stock Exchange was the beating heart of India's capital markets. It was the place to be, until the 1990s arrived with a storm. In 1994, the government-backed National Stock Exchange was born. While BSE was struggling with outdated systems, NSE brought tech, transparency, and a ruthless plan. They weren't just competition. They were engineered to replace the BSE entirely. BSE still relied on open outcry. NSE had electronic trading from day one. Investors fled. By 2001, BSE's market share plummeted below 10%. NSE was swallowing it whole. But here's what no one expected. BSE fought back. With new leadership, modern tech, and unique derivatives products, it slowly clawed back relevance. BSE's revenue doubled in FY25, 3,236 crore. In its 150th year, BSE posted its highest revenue ever. The underdog lives. And just when things were looking up, BSE quietly sold its prestigious training arm, BSE Institute, for just £16.9 crore. Was it strategy or desperation? If you thought this story was wild, wait till you hear about India's stock market scam no one talks about. Subscribe, and I'll tell you that next. Comprehensive Equity Research Report, Bse Ltd. One company overview, business model. Bse Ltd is a stock exchange providing trading services across equities, derivatives, mutual funds, and debt instruments. Segments: core exchange business, clearing and settlement, mutual fund distribution, BSE Star MF, and subsidiary ventures, India INX, Beam, Bse. Geography: primarily India-focused, with India INX in Gift City targeting international investors. Milestones: FY25 150th anniversary, record revenue of Rs 3,236 crore, 81 IPOs listed, raising Rs 1.82 lakh crore, BSE 150 index and commemorative initiatives launched. 2 deep dive, FY21 to FY25 reports and calls. A. Business updates: explosive growth in derivatives and mutual fund segments. Co-location infrastructure scaled from 0 to 300 racks, aiming for 500 by FY26. Divested BSE Institute to focus on core operations. CapEx focused on tech upgrades, clearing infra. B. Risk analysis: regulatory uncertainty, SEBI reforms, gross limits, clearing separation, dependence on derivatives sensitive to volume fluctuations, global geopolitical risks affecting capital flows. C. Management and governance: CEO Sundar Raman R credited for turnaround strategy, realistic guidance, strong execution history, clean governance with increasing transparency. 3. Competitive landscape, main rival, global peers, SGX, HKX. SWOT analysis: strengths, legacy brand, unique products, Sensex derivatives, diversified revenue streams. Weaknesses: lower liquidity versus NSE. Opportunities: Gift City, institutional adoption via contract note reform. Threats: regulation shifts, NSE dominance, tech disruption. 4. Newsflow analysis 2023-2025. Positive: strong earnings, special dividend, derivative growth, institutional push with colo infra. Neutral under radar: BSE Institute sale, delayed implementation of common contract note. Sentiment bullish from both media and management. 5. Valuation investment view: PE ratio TTM, historically in 25 to 40x range. Recent run-up from earnings spike. Peers: cheaper than global exchanges, but premium versus domestic non-exchange players. Analyst view: positive on growth, cautious on regulatory overhang. Risk-reward: attractive if derivative momentum sustains and reforms are favorable. 6. Conclusion and investment rationale. Justification: strong earnings visibility, 150-year trust brand, high-margin businesses. Catalysts: full implementation of contract note reform, colo ramp-up, index derivative adoption. Risks: regulation, NSE retaliation, liquidity shifts. Margin of safety: high. Strong balance sheet and dividend yield act as buffer.